Adrian, can I just ask this question? So something that's been running through my mind, you talk about an infinite lifespan of investment for Patron. What if I'm an investor and infinite doesn't play out for me and my circumstances change and I want to exit? What's the scenario there? Can you walk through that?
Yeah, our objective with Patron Companies is to eventually become a public company. That allows our investors to get some liquidity and they can manage the liquidity they want. Very importantly, it also allows the compounding to continue. We do not want to set up a structure where we have to break that compounding. So an IPO is the eventual exit for us, perhaps in 5 years or so. Many, many companies that we're modeling Patron off overseas have gone down that path and are now very successful public companies. So we think that's where the majority of liquidity for our investors will come from, but they'll be able to manage that liquidity and continue compounding. There are other ways we can manage liquidity for investors over time. There will be future equity raises because the opportunity set's so large for us that we will be raising some additional equity, but very quickly the model becomes self-funding, and then we can pursue our strategy without needing to go back to the equity markets again and again and again. But there will be one or two more opportunities for us to do that, and that may also be an opportunity for existing investors to get some liquidity in a secondary sale of shares. There is also opportunity for us to buy back some shares selectively from investors over time to help them manage liquidity needs that they may have. The decentralized serial acquirer model becomes enormously cash generative. And we think we'll very quickly get to the point where we have a very diversified portfolio of companies that are generating enormous amounts of cash. So there is plenty of opportunity for us to potentially introduce a dividend, or, as I say, to offer a buyback of investor shares to create that liquidity. But it's a very attractive part of this model. We're buying existing profitable businesses, which lowers the risk, and over time we end up with a very diversified portfolio of well-established, profitable, cash-generative businesses. So the companies overseas that are our spiritual guidance are enormously cash generative. We will become enormously cash generative. So that creates great opportunities for liquidity. It's worth noting that when those companies that I've mentioned, like Roco, like Lifco, and others like Constellation Software, who are similar in nature, when they went public, they didn't raise any cash for the company. It was purely a mechanism to deliver liquidity for their investors. So it was a purely secondary sale of existing investor shares when they went public. Because they're so cash generative, these businesses, they don't need to raise any more money.
So for those companies, would that have always been in the plan? Or would have likely in those scenarios been investors requesting liquidity?
Look, I think many of those companies evolved over time. Many of those companies like Indutrade have been public for decades. Constellation Software has been public for decades. So for those that have been established more recently, like a Roco, an IPO was the eventual exit for them. For us, an IPO is the most likely eventual liquidity event for investors. But for us, we want to keep doing this forever. So an IPO doesn't really change much other than create that liquidity opportunity for those who want a bit of liquidity. We intend to keep going, and the compounding will really have just started at that point. There's still many, many decades of compounding beyond being a public company.